Sir, I've admitted everyone, so rest they can join without waiting room, sir. So if you're ready, we can start.
Okay. Very respected and honorable Central Council member of ICA, CA MP Vijay Kumar sir, and learned resource person of the day, CA GN Ramaswami sir, CA Panaraj, Secretary of SCRC, participants of this special and weekend program for members, particularly for members industry. A very good morning to all of you. It is a delightful morning for me to join in these 24 hours intensive sessions spread over 12 days on vital subject on the India is more specifically designed for the members industry. To inaugurate this program, we have with us a very, very apt person and guru of accounting standard, CMP Vijay Kumar sir. On behalf of this great region, I welcome you, sir. I welcome him for this excellent program and thank him for accepting our invitation in very, very short time. Thank you so much, sir, for our love and affection towards the professions and encouraging us, for encouraging council members like me to do more programs, knowledge-oriented programs. I'm happy to welcome the resource person of the day, CA GN Ramaswami sir, for this excellent program. I have a great pleasure of extending our warm and cordial welcome to all the participants to this excellent program. This program has been so designed that the members are provided with a high value addition on the various provisions and implications of the standards as to comply with the statutory requirements of these regulators. SCRC has been expanding year after year the panel of resource persons throughout the southern region. We are fortunate to have the wide range of experts in all the areas of our professional arena. And in the subject of India is too, we have an expert team of resource persons for this week-long program. SCRC is extremely thankful to all the resource persons who have considered to our request to spare their precious time, that was early morning, to share their analytical skill in the subject of India is. Most importantly, CA Sinasamy Ganesan sir and CA Gopal Krishnan Raji for their continuous support to this program is invaluable for the success of this program. Our members are in large proportions having their career in industry and are in the key positions as the finance managers, chief financial officers, and the chief executive officer. They play an important and decisive role in the decision making of the management. Besides, they bring in the field of finance and responsible for a proper and accurate with the timely presentation of financial reporting and most importantly, disclosure requirements of the organization. Need to keep themselves aware and abreast of the facets of the standards in India is. We in SCRC have been conducting programs catering to the needs of both the members in practice as well as members in industry. However, it was felt that the exclusive program for members in industry may attract more number of participation from the members in serving in industry. Keeping this in mind, we have designed an exclusively 70 hours GP program for members in industry with a one-time registration fees. Today will be the last date for the registration. We have received excellent response going by the registration. I also request the members to disseminate our scheme of offering this unique CP programs amongst our colleagues and friends in the working in industry. It is in this context that this NDA's program could offer the necessary knowledge updation and value addition to the participants. We have therefore structured the program to embed many of NDA's in a capsule form of 24 hours overall. The primary objective of this standard is to ensure uniformity in the reporting framework to make the same in transparent, accessible, and convenient for the end users. With this dynamism of the business activity across the globe being witnessed, there is a need to revisit the existing standards and bring in new standards as may be required from time to time. It is in this respect, 24-hour session covering the significant areas of India's will give further insight on this applicability and adoption by the members in industry during the course of their discharging the duties entrusted. I am sure the entire duration of this course will offer you an enlightening and enjoyable experience and keep you engrossed throughout the session on all the 12 days. MPV sir has over 27 years of experience in industry and as a chartered accountant in practice. Now he is the Central Council member of ICA for continuous 2 terms and a member of various standing and non-standing committees of ICA. He is a vice chairman of expert advisory committee. The most importantly, the chairman of Accounting Standard Board. He is a nominated member of SAFA Committee on Accounting Standards. He is the very good resource person of ICA in India and abroad as well for various subjects, including the accounting, auditing standards, IFRS. He is the member of IFRS Advisory Council. He is presently in director in various corporates, including XBRL India Limited and the former director of National Internet Exchange of India. He got award Best CFO and top 100 CFOs Influential Award at national level. He is a great asset for ICA and the most inspiring personality among the chartered accountants. He is a great motivator for many of the young chartered accountants and the council members to work better for the development of the institute, ICA, and the country. With this, I request MPV sir to address about 15-20 minutes about his thoughts among the participants, developments in ICA, and the importance of India for the benefit of members. Over to MPV sir. Thank you so much.
Thank you, Jalapati, for the invite, introduction of the event, and also my introduction. Thanks for those very kind words, deeply humbled. Greetings to all. Trust all are safe and your near and dear ones are in good health. Happy to recognize the presence of Secretary Anaraj. In fact, he doesn't miss any program of the Institute in terms of participation. And thanks to all the faculty members who have agreed to give their time for this particular program. Very happy to note this well conceptualized weekend learning on Indias with very good speakers, all of whom have good hands-on experience in implementation. Let me express my sincere thanks to the entire accounting fraternity for their active participation in India transitioning to Indias, the IFRS converged standards. I'm very proud of the way we have transitioned seamlessly. Full credit to the members in practice and in industry. It is our endeavor to ensure consistent application of the standards. When in doubt, I request extensive usage of basis for conclusions of the corresponding IFRS, discussion papers of International Accounting Standards Board, agenda editions of IFRIC, and refer to the conceptual framework. And importantly, please do not hesitate to consult with professional colleagues and peers in the industry. Also, we have a 20-minute video lecture on each index in our digital learning hub of the ICAI. India has to be a leader in quality of financial reporting, which we rightly deserve, and I seek your active participation in this journey. I have been a firm believer that accounting is about being accountable and financial reporting is communication. The balance sheet is a communication, income statement is a communication, cash flow statement, notes to accounts, all of them are communication. Every communication has to meet 3 objectives. A, they should be clear, complete, and candid. Just like each of us expect in our personal life, the communication we receive from family members or from colleagues at office or anyone, we expect any communication we receive to be complete and truthful. The same is applicable for the communication which is done through the financial statements. We also need to acknowledge that good accounting leads to good economics. Ind AS is here to stay, and few years from now, banks and insurance companies will move to Ind AS. Also, given that Ind AS and IFRS are almost the same, there is a lot of professional opportunity across the world. As an illustration, financial reporting for almost all of the Fortune 500 companies happens out of Gurgaon, Pune, Chennai, and Bangalore. Soon, the audits for these will also happen out of India. Physical location just does not matter anymore. The pandemic has made us believe it, and it will be audited anytime, anywhere. The journey of developing best practices in accounting is still on. There are several areas of improvement. IASB is in the process of issuing a new presentation format for financial statements. So the income statement which you now see will be in a different format, where the income statement, just similar to cash flow statement, will have income which will show how much is from your operations, how much relating to your investing, and how much relating to your financing activities. That's a new format which will most likely hit the road from 1/4/23 or 1/4/24. The IASB is also amending the management commentary statement. The international exposure draft, we have issued it in India now. The idea is to enhance understanding of financial statements. My 2 cents on Ind AS versus AS. And with this, I'll try to remove some of the myths on Ind AS. Ind AS and AS are both same, except for 3 important differences. 1, a more qualitative usage of, I reiterate this expression, qualitative usage of the concept of substance or form. Second is a higher fair value usage relatively. Let's appreciate accounting standards also use fair value. In Ind AS, we have a little higher usage, particularly in the context of financial instruments, and rightly so. And third, higher disclosures, because financial statements by their nature involve lots of estimations and judgments. It's important the users should know the basis of all those. I'll spend an extra minute here. Many people have an impression that the accounting standards are meant for preparers and auditors. They are not. They are not. The entire accounting standards, when they are developed keeping in mind the interest of the users of financial statements. Is the accounting information useful to the user of financial statement? As a preparer, as an auditor, some of these can appear to be an overload, but important is, as a user, is he getting the right kind of information to take an informed decision on investing, staying invested, lending, etc. So all the accounting standards, they're prepared with a single-minded focus of being relevant to the user. And when I prepare financial statements, it is for the user. When I express an audit opinion, it is for the user. So whatever we do should be relevant for the user of financial statements. So my request is, whenever you look at accounting standards, look at it from the perspective of a user. Is this information relevant to him? Is it in an understandable format to a user of a financial statement? I understanding doesn't matter because I know any case, but it is for a user which is most important. Let me now highlight 3 important developments in Ind AS which are relevant now. One is amendment to the definition of the word material, and I would encourage using this revised definition, even though it has not been revised in audit standards, to use this. The revised definition of material in Ind AS 1 provides that information is material if omitting something, misstating something, or obscuring. This word obscuring has been added now, could reasonably be expected to influence the decision that the primary user of financial statements may take on the basis of financial statements. So they have added this third dimension where you may give a correct information, but the way you give, if it is going to obscure it, then also it is treated as material. And that obscurity which you bring in can be a case of negligence as well. So that's a very important definition change. Second is, we have the conceptual framework for reporting under Ind AS. For standard setters, it became mandatory last year. And for preparers, it is applicable from current financial year, April 21. This conceptual framework replaces the earlier framework, and this is not a standard and does not override any specific standard. Hence, it is not part of the standards which are pronounced. The conceptual framework has 2 sets of qualitative characteristics, and it's very important that whether preparers or auditors here, when you are engaging your teams, they should ensure that they are applying the standards, keeping in mind these qualitative characteristics. One is called fundamental qualitative characteristics, which is relevance and faithful presentation. Second is what we call enhancing qualitative characteristics, which are considered to be less critical but desirable: comparability, verifiability, timeliness, and understandability. The third important development is the Council of ICAI has approved Ind AS 117 on insurance contracts and an adjacent amendment on Ind AS 40 allowing fair value accounting model. And we have now approached MCA for notifying the same soon. Now let me step aside to seek your active support for India contribution in IFRS standard setting. As all of you would have experienced, Ind AS and IFRS are exactly the same, and whether it is the government or the institute or the government's consultative body called NFRA, all of them have a common commitment of ensuring compliance with the best reporting practice in the world, and it includes IFRS. Over the years, we have increased substantially our engagement in international standard setting, so that we should feel that IFRS is our standards and not adopting someone else's. So when you are actively contributing in the development of an international standard, that international standard is as much yours as it belongs to everybody else. Many have this impression that you are adopting somebody else's. It is true if you are not involved in the preparation. If you are involved in preparation of the international standard itself, that standard becomes your own standard. And I request your active participation in the exposure draft of all the International Accounting Standards Board document. And please note, the best opportunity for you to contribute your views is at the time of the international exposure draft. The reason is, at that stage, whatever views we give are most likely the views we will carry when we issue the corresponding index. So you don't have that second opportunity later. So if you have agreed at the international exposure draft stage, when it comes to index, in local one, notifying locally, it's very difficult to take a different position. At ICAI, we now respond to every exposure draft of IASB, tentative agenda decisions of IFRIC, and participate in every international and regional forum meeting. I'm sure among the participants here, many of them are following IFRS or Ind AS, and please follow me with rapt attention on this very important point. Many of you will be aware that there is what is called agenda decisions issued by IFRIC. These agenda decisions have the same authority, I reiterate, have the same authority as a standard, and Ind AS 8 has a hierarchy which provides that beyond Ind AS, you should look for guidance in similar literature, which is IFRS, its basis for conclusions and agenda decisions. So indirectly, the agenda decisions which are issued internationally, which are similar to EAC opinions, are binding on all of us. So we cannot say I'm following Ind AS by just looking at the Ind AS notified under Companies Act. You need to look beyond. We, namely the Institute India, are chair of an important regional forum of IFRS Foundation for last 2 years. We are a member of the IFRS Advisory Council to IFRS Foundation and IASB for last 3 years. And we are also a member of the IFRS Small Medium Enterprise Implementation Group now. We have had members from India in the preparers group of IFRS in the IFRS Foundation, people like Mr. Birendra Sanyal from TCS. And from India, we have Shri Vinod Rai as trustee on IFRS Foundation, which is the highest body. And prior to him, former SEBI chairman, Mr. Bave, was the trustee, and Mr. Mohandas Pai was also a trustee of IFRS Foundation. I'm sharing this just to tell you that there is so much of active involvement of India in the global standard setting organization. And for every new major exposure draft, the International Accounting Standard Board reaches out to Institute for an outreach program in India. We have done a couple of such outreach programs recently. And in a major project, the first of its kind in India, before every exposure draft is issued, International Accounting Standard Board does what is called as a field work, where they select a few companies and ask them to prepare financial statements applying the exposure draft. If you apply exposure draft, how will the financial statements look like? Happy to share 4 large Indian companies. We are in an NDA, so I can't share the names. 4 large Indian companies have participated in such field testing as well for the exposure drafts which are issued internationally. And IASB, as I mentioned, is in the process of issuing several improvement guidance over time. As I come to conclude, my sincere appeal is that, particularly for practicing members, while we practice in many areas, tax, consulting, etc., government and all stakeholders have a primary expectation from Institute and Chartered Accountants in terms of high quality financial reporting and audit. Simple reason, the Institute is set up under the Act with a one-line objective for quality of accounting profession. If we have to enjoy respect, command stature and stay relevant, it is important that we should excel in the quality of financial reporting and audit, while of course all other areas of practice are important. A word on future perspective. The users of financial statement, and I request once again your rapt attention, the users of financial statement have a clear expectation and have met user groups in India and globally. Everyone has this clear expectation that historical information is not very relevant. They're all expecting information which will give predictive value. Take our own personal life. We are no longer interested in knowing the distance between place A to place B. Our interest is how much will be the time it will take to reach place B. If I leave at 9 o'clock in the morning, leave at 4 o'clock in the evening, I want that predictive information. So what is true for personal is true for the financial statements and users of financial statement. For the profession to stay relevant, it is important that our output in financial statements and audit opinions, in the form of financial statements and audit opinions, have to have that predictive value. It is certainly tough, but inevitable. We have to develop ways over time to reach that goal. I would like to quote our founder president, late Shri G.P. Kapadia, whom I adore, and his words way back in 1950 hold true today also. He says that, to quote, the profession's resilience and practice to respond to the changing situation and growing demands on it will determine its continued existence and growth, unquote. Thank you for your patient listening, and I wish you happy learning. Stay safe, stay accountable.
Thank you, sir. Thank you so much for our great inputs, as usual, relating to standards. My sincere thanks and a great salute to our dedication, sir. The dedication and the passion towards serve ICI. Thank you so much, sir. Members, SARC endeavors and assures to conduct many more programs, keeping in mind the requirements of members in industry in the days ahead. I also take this opportunity to invite the suggestions from members in industry as to the areas they prefer SARC to cover in their future programs. I think the more than 200 members attending the early morning weekend. A great salute to each one of you for our active participation. With this, I request Secretary of SARC Panaraj sir to introduce today's speaker of this morning.
Yes. Good morning and thank you, Chairman. Thank you very much, MP Vishal, for setting the tone for the day's program. I take the pleasure of introducing the opening speaker, G.N. Ramaswami sir. G.N. Ramaswami sir is a chartered accountant with over 28 years of post-qualification experience. He is serving in large and medium sized clients in the areas of statutory audit, encompassing financial reporting standards, apart from advising clients in strategies for governance, restructuring, acquisitions and related valuations and tax implications. A commerce graduate and a fellow member of Institute of Chartered Accountants of India, Ramaswami sir is an ISA, that is DISA ICA, and also holds post-qualification certificate of ICA in International Financial Reporting Standards and International Taxation. He is also a registered insolvency practitioner, professional, and a registered valuer for securities or financial assets. He is empaneled as an independent director with the data bank maintained by ICA. Ramaswami sir possesses a wide experience in listed companies and other entities in private and public sectors across bank and financial sectors, manufacturing, trading, plantations, consumer products, logistics, hospitality, healthcare, and media. He has presented papers in seminars and study circle meetings and has given guest lectures in ICA, ICWA, the Society of Auditors, and other professional bodies on topics related to tax and corporate law. He has been an active member of study groups formed by the SIRC of ICA to review accounting standards, auditing standards, and guidance notes. He was a member of the Chennai subgroup FRRG during the year 2016-17. He is Secretary of the Society of Auditors Chennai, one of the oldest accounting body in India. He is passionate about his hobbies as he is about his profession. Photography and travel inspire him. He is the treasurer of Photographic Society of Madras, Chennai, one of the oldest photographic association in the world. With this, I introduce the illustrious speaker for the day, and over to you, sir.
Thank you, sir. Thank you for the nice words. Is it visible?
Yes, sir.
Thank you. I thank SCRC for giving me an opportunity to present a paper on IND AS 1 and IND AS 8. I also thank MP Vijay Kumar sir as well as Ramaswami for organizing this program, particularly for the members in the industry. MPV sir has given a very good intro, and he has given set the tone for this meeting for the next 12 days. The program has been structured in a fantastic manner so that it will give an idea about the IND AS for all the standards which are very important for preparation and presentation of financial statements. He has also given the importance of what are the steps we need to take by preparing the financial statements. As you're aware, a couple of days back, SEBI chief has raised some concern on the IFRS financial statements. He said most of the companies are just using it as a checkbox item. That is just to give the minimum information, just to comply with the standards and not giving much importance to the real requirement. As I said, the users need to get the information about the company, its position, etc., from the financial statements. Unless the details are given as envisaged, it's not going to give a clear picture. The main reason what I see is due to giving not much importance for the preparation of disclosures as required in the standards. Normally, what all the companies will do, they will prepare the financial statement just before a couple of days before the board meeting, so there will not be much time to collect the information as required for disclosure under the various standards. So it is a year-long exercise. Whenever there is a transaction happening, we need to decide whether this has any relevance in the disclosure or it requires any further inputs that need to be disclosed in the financial statements or elsewhere in the annual report. Then those details to be stored separately for easy retrieval at the year end. It will facilitate the company to ensure that none of the items are omitted or ignored while preparing the financial statements. It will help the auditors also to collect information with ease so that the company can discuss with them regarding the options and their availability, so that it will be easy for them to provide a good financial disclosure. With this, I will start my session. First one, I'm going to take about the IND AS. The participants can raise their queries, if any, in the chat box. At the end of the session, we can answer that. If due to any possibility of time, if unable to cover all the questions, definitely I'll revert back on that by way of mail. I'll give the answers to the institute so that they can share with the participants. The standard, most of the things has already been covered by MP sir, so that my job is a bit easy now. He has informed about the basis and other things, so that it's a cakewalk for me. Both the standards are more of theoretical. So in the subsequent sessions where we are going to discuss all these items in detail with a practical perspective, this is just to set a tone of the fundamental requirement or to prepare the financial statement. Under our IGAP perspective, we have AS1, that is disclosure of accounting policies, but IND AS is a bit elaborate. It is, as you are aware, this is a principle-based standard. It's not a rule-based. So they will give the guidelines to help us to compare the data and present in an appropriate way, so that we can decide, and we will be given with certain options which we have to evaluate and decide what are things that need to be produced in the financial statement. The scope of IND AS 1 is nothing but, as you are aware, as MPV also said, there are two types of financial statements. One is general purpose and another one is special purpose. This standard is applicable only for the preparation and presentation of general purpose financial statements. It's not applicable for any special purpose financial statements. What is general purpose? It is for the large users. So who need to get the information about the company, who can't decide about any specific requirement on the financial statements. So normally all the financial statements prepared for shareholders or for regulatory filing, etc., will be treated as general purpose. In India, we will be preparing the financial statements as regulated in the Companies Act, which will be tabled before the shareholders, and also it will be used for filing the tax authorities. This is just an example of general purpose. Special purpose is something different, where the user will give directions to the preparers that I need this information in a particular format. So the financial statements or financial information will be prepared to cater their specific needs. It is not for a general need. So that is totally different. So we may take some of the principles from the international standards or India's for preparing those financial information or statements, but prima facie, this standard is applicable only for general purpose financial statements. What is the objective? The objective of the financial statements is to provide information about the financial position, financial performance, and cash flow sensitivity that is useful for the wide range of users in making economic decisions. As informed, unless the information is flown to the users, they will not be in a position. Just close this chat box. So that is vital for the users to get the information from the financial statement. For example, the financial portion we can see from the balance sheet. P&L will show us the financial performance, and the cash flow will show us what is the inflow and outflow of cash and how it is being used by the entity. This information, along with the notes on accounts, which is more important. See, for our old IGAP, we will be confined only to P&L balance sheet and the narrative notes. That is numerical notes. But when you go to Ind AS, we have to give much importance to the descriptive notes. That is more important. We have to give a lot of information as required by various standards. So it will help us to get additional information as required in the statute, also under the standard setting body, so that the user will get additional information to get a full perspective of the entity. So we need to ensure that this giver appropriate financial position, performance, and cash flows of the entity, so that the users can get what they require. Let us briefly see what are the components of financial statements as per Ind AS 1. A balance sheet as at the end of the period, a statement of profit and loss for the period, statement of changes in equity for the period. This concept is new. For those who are following IGAP, this is something different. A statement of cash flows for the period, notes comprising significant accounting policies and other explanatory information, comparative information in respect of the preceding period, both narrative and descriptive. A balance sheet at the beginning of the period where applicable, that I will touch upon at a later point. A single statement of profit and loss with profit or loss and other comprehensive income presented in 2 sections. This is also something unique in Indian perspective. An entity to present all this information in an equal prominence. We can't give certain weightage to some of the information and a lesser weightage to some other information. That is not permitted in India. We have to give equal prominence to all this information in our financial statements. So I'll come back to the comparative information first. As I said earlier, we have to give the information both for narrative and descriptive. So more and more details to be collated while preparing the financial statement itself, so that those disclosures are appropriate. Regarding the changes, statement of changes in equity, this is peculiar to India's preparers, where we need to give some of the items as required therein for the current year as well as the preceding year, which need to be collated. Nothing but share capital, reserve surplus, etc. will be present in different format as required under the standards. Similarly, P&L at 2 parts. One is profit and loss, other one is other comprehensive. But these two to be provided in a single statement as a total comprehensive in India and Ind AS. But IFRS requires this to be presented at 2 different statements. But in India, to get a better readability to the readers, this has been provided that it has to be provided in a single statement. This is the broad components of the financial statement. So these things all put together will form part of your financial statement for a particular year. Regarding the balance sheet at the beginning of the year, whenever you are converging to Ind AS, we need to give opening balance sheet or some other reasons I will be touching upon at a later slide. Those cases we need to give a that balance sheet. Now, otherwise, normally it will be 2 balance sheet, 2 P&L with corresponding notes and disclosures in the financial statements, both narrative and descriptive. As I said earlier, India is just like IFRS is a principle-based standard. It's not a rule-based. They will give just guidance as to how to prepare the statement, and for the users to decide which one will be better, so that the real information can be given to the user. It just provides the content of the financial statements and not the format. India doesn't specify any format what you do, but it will say what are the things that need to be included in the financial statement. It is for the users to preparers to decide how it has to be presented, so that it will give a correct picture about the entity. As you are aware, in India, the format of financial statements are prescribed in Schedule 3. Priorly, the old regime under IGAP used to have a Schedule 6. Subsequently, it has been amended to when we got the Companies Act 2013, it has become Schedule 3. Division 1 talks about format of financial statement for those entities following IGAP. When India has been introduced, Division 2 has come into force, wherein the format has been prescribed for companies who are following India. Now, Division 3 is there for NBFCs. So, to comply with the preparation of financial statement, we have to see both India's 1 as well as Schedule 3, so that nothing is omitted. So, we need to be sure about all the disclosure requirements both under India's 1 as well as the format as specified in Schedule 3 are being collated properly, so that the financial view. What are the features? I'll just go through these items in detail in the subsequent slide. The true and fair view and compliance with India's going concern. As you're aware, we have to prepare the financials on a going concern, accrual basis, materiality and aggregation, offsetting, frequency of reporting, comparative information, consistency of approach. All these things, some of things are applicable or high gap also. Some of things are new words, though we are following that without understanding the terminology, but it is common for both in most of the cases. True and fair view. As I said earlier, the financial statement what we give to the shareholders or to the users must reflect their true and fair view of the financial position, financial performance, and the cash flows. So the balance sheet and the P&L and your cash flows must give a true and fair view. It should not mislead the users. So it requires a faithful representation of the effects of the transactions, other events and conditions, in according to the definition of the framework of asset liabilities, income and expenditure, etc., as set in the framework. So we need to have a proper presentation of all this information as required in the standard, so that it will give a true and fair view. And in India, we need to give an explicit statement that we are compliant with all the India's standards as applicable in the notes. It has to be given, it is a mandatory requirement, so that we are giving a confirmation that all the standards as applicable to the entity have been compliant with. So we can't have deviate from the standard. Once if suppose a particular standard is applicable to you, you can't deviate from standard, and we can't say that this is the standard policy I've used for this company, and that not be made right by giving a note or explanatory information. That is not permitted unless extremely rare circumstances. That is all specified in the standard. Otherwise, we need to strictly follow all the standards, and that has to be explicitly stated in the financial statements. So here in India, there is no question of qualification or non-compliance accounting standard. That is not permissible. In IGAP, we used to do some of the cases where it is not compliant with the audit used to qualify the statement, but in India's regime or IFRS regime, that is not permitted. There should not be any qualification in the report for non-compliance of standard. Next is going concern. As you're aware, the fundamental thing is that all the financial statements are prepared on a going concern basis. That is a normal thing. So every statement's balance sheet will be prepared on a going concern basis. To do that, management has to do a review on a yearly basis to assess whether the entity is able to continue as a going concern. That is, the company in the position to meet all its liabilities, will be able to continue its operations in the next 1 year, will be able to meet all the liabilities, etc. So the management will assess based on the current scenario. So, as I said, all the statements are prepared on a going concern basis unless the management intends to liquidate the company. That can be cases where the management wants to close the business, or they have to stop the trading, or there is no other alternative. They are forced to do close the business, etc. In the case, the financial statements can't be prepared on a going concern basis, then they need to go by cash basis or relation basis of accounting. And when they are assessing whether the company can continue going concern, there may be certain uncertain elements which is factored, but that is not a detrimental factor, but the accounts will be continued as a going concern. But those factors that is affecting the uncertainties shall be disclosed. They should not just say that it has been prepared on going concern. That what are the basis on which it has been prepared, and how the decision has been arrived that the company can continue going concern will also be disclosed in the financial statements. If the financial statement is not prepared on a going concern basis, then they need to give the reason for the same, and also the basis on which it has been prepared. These are the things as far as going concern is concerned. Accrual, as you are aware, that it has to be prepared on accrual basis, except cash flow, which need to be on cash basis. Materiality and aggregation. We are during his opening remark as discussed in detail about the materiality. This is one of the fundamental changes. It has been happened in the last year, July 2020. So now materiality, the definition has been changed. I will just touch upon once again, though he has given a fantastic explanation about this. Each material class of similar item shall be presented separately. So we need to disclose all the material class in a separate line item. Similarly, each items of discipline nature or function shall be presented separately unless they are immaterial, except when required by law. Even if it is immaterial, if a rock requires certain things to be disclosed in the financial statements, that need to be disclosed. So there we can't say that it is not material to disclose. Even you would have seen some of the larger companies where they are rounding off in lakhs, there will be some numbers in the face of the balance sheet or in the notes dash, but there will be asterisk or number with a footnote saying that they would have given the number in absolute numbers. It will be 1,000 rupees. It will not even the decimal factor. But if it is required by statute, they have to give the information irrespective of materiality. So that we have to have in mind, we can't just ignore certain information that is to be mandatorily given as per the statute, merely because it is immaterial or very insignificant. Even some information, maybe 10 rupees or 5 rupees, need to be disclosed if that is required by the law. On seeing the larger balance sheet, you can see there will be a lot of line items in the balance sheet end up with the figure as dash, but with asterisk or notes with those details in the footnote. What is materiality? Information is material if omitting, misstating, or obscuring. It could reasonably expected to influence decisions that the primary users of general purpose financial make on the basis of this financial information. So not only omitting and misstating. Previously, it was only omitting and misstating. Now they use the word obscuring. So I am giving information, but that is not given in a proper way, or it is misleading the reader so that they get a different perspective about my financial performance. That is not a proper way, so that will affect the materiality. So the entity shall not reduce the understanding of the financial statement by obscuring material information with immaterial information. So I should not substitute some information which is not relevant for the purpose, but reading this information along with the material information, the readers may get a different perspective that is not treated as a proper way. So this nomenclature is totally new to us. It could be because of the language used, the way it is presented, not cross-referencing, use of a highly technical or ambiguous plan. Suppose some key information which is vital for addition is not properly linked to the main notes or balance sheet. That is not a proper way to disclose. We have to cross-reference everything. And highly technical and ambiguous language. The users must understand, as MB sir said, we have to prepare the financial statement from the user's perspective, not from the preparer's perspective. I know what it is. I know what is the transaction. We know what will be the impact of this in the current year as well as in the future year. But the users must understand. So I should not mislead them by putting too much of technical or vague words in my notes or in the financial statement so that it will mislead them. And there should not be any necessity to read in between lines. So it must be transparent, it must be simple, and it must convey what is the purpose. Offsetting. If we are used to this, we should not offset the assets and liabilities or income and expenses unless required according to the Ind AS. This is the fundamental assumption. So we should not unnecessarily do any adjustments of any assets or liabilities or income and expenditure unless it is permitted. But normally, when we do prepare the financial statements, we used to make a provision for inventory subsistence, or we used to provide for doubtful debts, which will be shown as a reduction from the respective assets. That is permitted. That is not treated as offsetting. Similarly, trade discounts and rebates will be shown as a reduction from revenue. Foreign exchange gain or loss will be shown as a net item. So we will not show both the gain separately and loss separately. We will show a net item unless it is materially, it has to be disclosed. If suppose any particular loss has happened, which a reader must know, then it has to be shown separately. Otherwise, normally we will show this as a net item in the field. 1 year it will be a positive figure due to exchange fluctuation, other it may be negative figure. Similarly, whenever we are selling some non-current assets or investments, we will be showing a net profit. That is nothing but the sale consideration as reduced by the cost of the assets and selling expenses incurred as a net item, profit on sale of fixed assets or profit on sale of investment, etc. That is a net item that is permitted. Similarly, warranty provisions will show a net item. These are all not treated as offsetting. Is adjusting an asset and liability or income and expenditure, which will mislead the information from the reader's perspective. Frequency. It is 1 year. That is a generally accepted terminology. All the financial statements need to be prepared for 1 year. That is also stated in the Pune standard. It can be your calendar year or financial year, whatever may be, but it need to be consistently followed. In case there is a change in the accounting year, suppose for example, till 31/3/2020, you prepared an annual basis. Now we are changing the accounting year from 31st March to December or to June. The period may increase or decrease. It may be more than 1 year or less than 1 year, in which case we need to mention the reason for a longer or shorter period, and also the fact that to that extent the financial statements are not comparable with the preceding year comparables. Because if it is for current year for 9 months and the preceding year for 12 months, then it is not comparable. Similarly, the other way also. Yeah, I'll reduce the speed. So this is one thing. So unless whenever there is a change in the financial year, we need to mention about that. Comparative information. As I said in my first slide, we need to give the comparative information for all the items in the balance sheet, P&L, notes, etc. It has to be both narrative as well as descriptive. See, most of the information, descriptive information will be relevant for the reader's perspective. So whenever it is required, we need to give more information about any of the transactions in the financial statements by way of a detailed note that will help them. Similarly, some of the notes, for example, there was a case which was pending last year, we would have given a detailed note, but we have to give further development in the subsequent financial statements. Otherwise, the users will not be in a position to understand the outcome of the case and how it has been adjusted in the financial, whether the company has won the matter or the company has lost the matter, what is the implications on its financial position, how it has been treated in the financial statement, etc., need to be properly disclosed. It will help the readers to understand the implications of the same. As I said earlier, the entity shall present a minimum of 2 balance sheet, 2 statement of P&L, 2 statement of cash flows, and 2 statement of changes in equity and related notes. So we have to give some additional information as required in this standard. So now I reduce the speed. I think it's fine now. So we have to give a third balance sheet at the beginning of the preceding year. The standard says under what circumstances we need to give the standard. That will come to a later point of time. So normally we will be giving a 2 balance sheet to P&L, 2 statement, everything with the corresponding figure for the previous year with a detailed disclosure in the notes as well as both descriptive notes also. Consistency. The format, and though India is not speaking about the format, in India we are following Schedule 3. We need to be consistent. We can't just keep on regrouping the numbers every year. That is not permitted unless it is required as per the standard, or that presentation will give a better readability to the thing. In this case, we have to explain that also. Otherwise, we have to follow a consistency. We need to have the same basis what we are, the format as required in the preceding year. That is one of the most important thing for India. But whenever there is a requirement under India that the change has to be made, then we can do that. Normally, the standard also says whenever there is a change, they will ask us to give some additional information to disclose what are the changes, how it will impact the financial, how it is, so the readers will get a better understanding of the same. With this, we have seen the main features. Now we'll go to the structure. As I said, this is a principle-based standard. They are not giving any direction as to follow a particular way, but it gives a guidance of what are the things that is expected to be present in the financial statement. So the entity, normally the annual report consists of some information, that is report, some other information, management discussion analysis, and also financial statement. So we need to clearly identify the financial statements and distinguish from the other information published in the public documents. So it must be separately identifiable. We should not give bits and pieces, some of the information in the notes, some of the information in other places. That is not permitted. The financial statement must be in toto. So all the information related to financial statements need to be given in a single place, and it must be clearly identified. What are the minimum information that is expected from the preparers? We have to give the name of the reporting entity and or other means of identification. If it is any brand or something which need to disclose, that will be disclosed. Any change in the name as compared to the preceding period, that will be disclosed. Whether the financial statement is for the individual entity or the group of entities. So that is whether it's for consolidated statements or for a standalone financial statement, that will be specifically stated. Date of the end of the reporting period, that is year and date, covered for both financial statements and notes. The presentation currency, whether it's INR or US GAAP, what may be, as defined in Ind AS 21. level of rounding off. So it is mandatory to round off the financial under Ind AS. Now in high gap also this year they've amended Schedule 3, which is applicable from 1/4/2021, where the word may has been substituted by shall. So rounding off is mandatory for high gap financial also from current financial year. For Ind AS, it is always a requirement. The content, very broad guidelines have been given in Schedule 3, but the Ind AS also defines what is the various content of the financial statement, namely balance sheet, assets and liabilities, property, plant, equipment, investment property, intangible, financial assets, investments, inventories, etc., where they specify what are the things minimum to be disclosed. They are not setting the priority in which it has to be disclosed, but it says that what are the things to be disclosed. Ind AS 1 gives a detailed thing. And we have to go for the respective standards. So for example, PPE, we have to go to the PPE standard to see what are the additional information that need to be disclosed by way of notes. But this information we have to read with your base standard Ind AS 1. And all this standard is talks about current and non-current classification. Now even IGAP we used to follow the same logic, but this index is a bit strict, or I say stringent in defining what is current. Non-current is what is not current is a non-current, but so we need to understand what is the current. So this is one of the most important things. Unless this classification is done correctly, all your other assumptions may undergo a change. Whenever there is a classification, whether it is classified as a current or not current, we have to disclose the information that will be realized within 1 year, or if we realize after 1 year also in the financial statement. That is also required. So let us see what is a current. For example, if a liability will be treated as current, if it is expected to be settled in the normal entity's normal operating cycle, or it is held primary for the purpose of trading, it is due to be settled within 12 months from the end of the reporting period, or the entity does not have any unconditional right to defer the settlement. All these cases, it will be treated as current. If it is not so, then it will be treated as a non-current. But a deferred tax liability will be always treated as a non-current item. It will not be treated as a current item. Similarly, when you come to an asset, it will be treated as current only when it is expected to be realized or intended for sale or consumption in the normal operating cycle, or it will be held primarily for the purpose of trading. It is due to be realized within 12 months, and cash equivalents unless there are some restrictions. In these cases, it will be treated as a current asset. In all other cases, it will be non-current assets. And also DTA, as I said in DTL, deferred tax liability, deferred tax asset will be treated as a non-current always. Here it will be followed very stringently. Even an outstanding a particular liability which is due for more than 12 months at the time of transaction, but it is outstanding for a period less than as on the balance sheet, we need to classify as current unless the entity can roll it over. As the decision-making power is with the company and it can roll it over, then it can be classified as current. Otherwise, it has to be classified as current. And in India, there is one specific change as compared to IFRS, breach of loan covenants. For example, if any of the conditions of the loan has been breached, because of which the lender can call back the loan amount. Suppose the long-term loan will be called back, so it will become a short-term. So it has to be classified as current, though the original, as for the original sanction, it is repayable after a period of 12 months. However, in Ind AS, it is used only as a material breach of covenants, but in IFRS, it is any breach. So any breach which give a lead to the lender so that they can call back the money, then it will be classified as a current. But in Ind AS, they are giving are a bit lenient. They are permitting only a material breach. Suppose before the closure of the financial statement, that is before 31st March, the lender agrees to rectify the breach within a period of 12 months from the end of the financial statement. That is, if you are preparing the financial statement for 31st March 2021, and the lender gives you permit time till 31/3/2022 to rectify this defects, then this balance can be classified as non-current. It can continue as non-current. Similarly, post the balance sheet, if the lender is giving a statement that it will not call for the repayment within 12 months, then also it can be classified as non-current. This is only from Indian perspective, not from IFRS perspective. So IFRS, whatever be the breach, if it is minor or major, whatever may be, if it gives a power to the lender to call back the money, then it has to be classified as non-current. And we have seen that it depends on the operating cycle. So operating cycle may vary from company to company, industry to industry. For example, a real estate company, the real estate, the operating cycle can be more than 3 or 4 years, but for some small manufacturing company, it may be for 6 months or 1 year, whatever it may be. Fundamentally, it is treated as a normally treated 12 months, but we have to see the company from that angle. What is the normal period? What is operating cycle? It is nothing but cash to cash. We are having cash that is used for procuring your raw material. Then we are manufacturing it. It is going to inventory. From inventory, we are selling to the customers. It goes to trade receivable. From trade receivable, it is being collected, again coming back to cash, and it is again used to purchase of raw material. This cycle is known as operating cycle. For some cases, it can be 6 months, it can be 8 months, it can be 12 months, or some cases it can be 4 years or 5 years, depends on the projects. For large projects like BHEL or infrastructure project, it will be infrastructure project, etc. It will be treated as 6 years or 7 years or what may be. So it is a variable from party to party. But for classifying current, we have to see whether it is reviewable within a period of 12 years or within the operating cycle. So that we need to review properly to give a proper classification. Then the statement of profit and loss. As I said earlier, it consists of 3 parts: P&L, the total other comprehensive income, then comprehensive income for the period, being summary of both profit or loss or other comprehensive. And in the information, we need to give what is the amount profit attributable to the minority interest and owners of parent. Here in India, we are using the word non-controlling interest. Previously, the same terminology as minority interest. That is now it is on NCI. Comprehensive income attributable to non-controlling interest and owners of the parent. This information to be given in the face of the P&L. Then, in addition, we have to give the statement of changes in equity, statement of cash flows, notes, disclosure of accounting policies, sources of estimation of uncertainty, capital, financial information, portable financial, etc., classified as equity. These are the things they've given a broad guidelines in the standard itself. What are the minimum things to be disclosed in the financial statements? We just have a broad review, comparison of your Ind AS 1, AS 1, and IAS 1. IAS 1 is nothing but IFRS. Contents that is specified in the standard, both in Ind AS 1 as well as IAS 1, but no such guidance in Indian accounting standard. That is IGAP. Reference statute, both IAS, Ind AS and accounting standard 1, we have to see schedule 3 for the format. But there is no such component in international standard. Rules of aggregation and desegregation, it has been given guidelines, but not in IGAP. Classification, yes, it has been given the details classification, what is expected for various line items, but no such guidance. We have to see only schedule 3 when we do accounts under IGAP. Changes in equity, this concept only in Ind AS or IFRS, not in IGAP. Operating income, other comprehensive income, we have as a separate line item that is not permissible in India. We have to show as in the P&L itself as a separate disclosure, but that is permissible in IFRS regime. External items, there is no such concept. That is not permitted both in Ind AS as well as IFRS, but in IGAP it can be presented separately. Non-current investment loans, as breach of loan covenant is already explained in detail. It can continue as non-current in India, provided it is not demanded by the lender, but no such concept in IFRS. Once there is a breach, that is a breach, then it has to be shown as current only. In IGAP, there is no guidance. We go by the normal principles. Reclassification, it is prescribed, but no guidance there in IGAP. Estimates, management estimates, judgment, etc. We have to disclose that guidelines have been prescribed in the standard itself. Uncertainty of estimates, yes, we have to give with the sensitivity analysis what is the impact of the thing we have to give. Aggregation of setting, it has been prescribed, no such guidance in IGAP. Specific disclosure of expenses, yes, for example, CSR expenditure, now schedule 3 has been amended to give various things, but in days previously they had some information. Rounding off, that is mandatory for both the standards now. Until last year, it was optional for IGAP, now it has been made as mandatory, but no such requirement in our international standard. With this, I completed my Ind AS 1. We can take the questions at the end of this standard also, because some of the topics are common for both. Just go through the questions and things. Yeah, someone wants 2 minutes break? Yes, definitely. Definitely, the copy of the presentation will be shared with the SRC. Will share. Hope I can start. In days 8. Here we are going to cover objective, scope, accounting policy selection application. That is more important. We have to select the appropriate accounting policy, because once you select an accounting policy, it is difficult for us to change the accounting policy in subsequent period. If you have taken a wrong policy, it will be difficult for us. So we have to prepare that balance sheet. We have to give additional what is the reason and all. It is very cumbersome in India's regime. So we need to spend more time to decide on the appropriate accounting policy. And as I said earlier, consistency. The accounting consistency we have to follow in application. We'll discuss those in details. Changes in accounting estimates, that is common. Whenever there is an estimate involved, it will undergo change the years to come. How that to be factored in the financial statements are errors and disclosures, and we'll cover every two also. Because this theoretical part on this standard is very limited. It is more of practical issues that we may face during a particular standard or our application. So we'll just have some of the questions. So Ind AS 8 specifies about the criteria for selecting and changing accounting policies, together with accounting treatment and disclosure of changes in accounting policies, changes in accounting estimate, correction of errors. This is one of the standards covers all these things. What are the options available on accounting policies? What are the policies to be selected? What are the treatment and disclosure for whenever there is a change in accounting policy, and whenever there is a change in accounting estimate, and also how to correct an error. These things are defined clearly in this standard. The standard is intended to enhance the relevance and reliability of the entity's financial statements. So the disclosure required in respect of the changes in accounting policy, etc., are set out in Ind AS 8. Other disclosures required to accounting policy, etc., are laid down in Ind AS 1, preparation of financial statements. So these two standards, whenever there is a change, we have to see the disclosure requirement as per Ind AS. But for preparation and basic things, we need to follow the principles laid down in Ind AS 1. In ICAP, we have only one standard, that is accounting policies AS1, but in Ind AS, we have two standards which need to be seen together so that the requirements are being complied with. So as I said earlier, this standard shall be applied in selecting the applying the accounting policies, accounting changes in accounting policies, changes in accounting estimates, and correction of prior items. The tax effect of the prior errors and responsibility adjustments are also stated in Ind AS. To be disclosed appropriately as per the standard. What is accounting policy? It's nothing but a principle, what I'm going to do for a particular transaction. For example, I'm purchasing asset, what I'm going to do. That is my policy. But we need a guidance. Otherwise, company X will follow one policy, company Y in other way, company C will do a different way. So they set a set of principles that need to be followed so that there will be uniformity. The reader will be in a position to understand how it has been accounted on reading the policy itself. So on reading a particular policy, you will know, oh, this is the way it has been done. So that is a fundamental requirement. So it is nothing but a set of specific principles, bases, conventions, rules, and practices applied by entity in preparing presenting financial statements. Why they are doing so much thing? Because everything can't be defined. See, the transaction may be unique for some industry that the regulators or rule setters can't envisage. So what will happen if we are coming across a particular transaction for which there is no guidance, how to proceed? We can't say simply that there is no guidance, I will do what I want. So they give a set of basis on which you can decide on the appropriate accounting policy, how you can select appropriate accounting policy. So the standard requires that when an India specifically applies to transaction or other event or condition, that accounting policy or policies applied to them shall be determined applying that particular Indias. For example, for a PPE, there is specific standard. For intangible, there is specific standard. For employee benefit, there is specific standard. For revenue, there is a specific standard. For any particular transaction, if a particular standard is there, then we need to follow the standard and comply with all the requirements, both for application as well as for disclosure. But there, as I said earlier, there can be changes, chances that there may not be any particular standard for any of the transaction for some of the unique industries, in which case what happened? So the management has to use its judgment in developing and applying accounting policy. We have to account that. It may affect both a P&L or balance sheet or both. Then the management will decide how it will be accounted. That has to be disclosed to the readers also. So management has to use judgment, but the standard gives the guidance also for that. So the accounting policy should be such that, so while selecting the accounting policy, we must have these things in mind so that it will be appropriate policy selected. If you have options, but while adopting or selecting a particular policy, we need to have these factors in our mind, relevant to the economic decision-making needs of the users. So to who is the user? So accordingly, we have to decide which policy will suit them most. Reliable in that the financial. So that is the fundamental thing is reliable. Represent a faithfully and financial position, financial performance, cash flows. So it must reflect a true and fairness, and also it must be faithful in disclosing information. Reflect the economic substance of the transaction, other events and conditions, not mere legal form. We should not go by legal terminology. So IFRS or India talks about substance or the form. We have to go by the principles. We have to see the substance, what is the transaction case. In some of the cases, there is permitted, even the accounting standard gives a particular guidance, but if it not give a true and fair view, we are permitted to follow a different methodology with proper explanation that is permitted in standard, because in some cases the following standard may mislead the user. So we have to see what is the substance. The selection of the appropriate accounting policy must be neutral. We should not select based on certain bias. Oh, if I take this standard, this option, it is beneficial for my. So we have to see from the reader's perspective, not from the preparer's perspective. So whenever we select accounting policy, we must be neutral. It must be prudent and also complete non-material aspect. So these are the basic principles which we must have while selecting an appropriate accounting policy. Whenever you are preparing a financial statements or accounting policy, selection of accounting policy is the most and important thing. Unless it is done properly, all your subsequent complaints will not give a desired result. So we have to spend more time to identify the appropriate accounting policy. As you are aware, India is converged to Indias in 2016-17 onwards, and most of the companies are now following Indias, barring some small companies. During the initial transitional period, we used to have preparers because at the time India is totally new. We are not used to Indias, and barring a few companies which are following IFRS for the purpose of their overseas requirement. But also following only IGAAP financials, it was a difficult task. We need to engage experts who are having hands-on experience on the requirements to help us to prepare the financial statements under India's perspective. At the time, we used to consult so many consultants to identify which of the options available will be beneficial for a longer run. So we need to select the appropriate accounting policy which will help us to reflect the true and fairness of your financial statements. So we have to spend more time in preparing the financial statements. We have to identify what are the how it is presented in the Indian GAAP, how it is going to be presented in India, whether we have any options. If so, which option to be selected, what is the pros and cons of selecting the particular option, etc. It will help us to identify the correct selection of the accounting policy, which is the first step, baby step. Only after identifying the accounting policy, we have to start doing our conversion process. So in making the aforesaid selection of the accounting policy, management shall refer to and consider the applicability of the following sources. The requirement of the India is dealing with similar and related issues. For example, PPI, as I said earlier, we have a physics standard, no issues. We have to simply follow that. Investment property, we have a standard, we have to simply follow that. The definition recognition, criteria and measurement concept of assessed liabilities, income and expenditure. Further, in making the judgment, management may also first consider the most recent pronouncement of International Accounting Standard Board and in absence thereof, those of other standard setting bodies that use similar conceptual framework to develop accounting standards. As said in the initial remark, MPV sir has said that whenever there is a evolution or whenever there is a change in ASB in IFRS standard, India has to follow suit. So obviously that correction will come in India maybe 1 or 2 years later, but we must understand what is the trend is going on globally so that we get ourselves updated with the requirement. So whenever there is a particular item is not covered in a particular Indias, we have to see what is the related Indias from which we can get the principles. We have to see IFRS, we have to see your US GAAP to get the principles. Based on that, we need to define the accounting policy for the particular company. Consistency is one of the most important things. Once you set up, adopt a standard accounting policy, we have to consistently follow that. There is no other option. So an entity shall select and apply the accounting policies consistently for similar transaction, other events and conditions, unless an India specifically requires the permits categorization of items for which different policies may be appropriate. So unless the India permits you to change, you are not supposed to change the accounting policy, and we have to consistently follow it. Changes. Having said that, we should not change, but there may be some compulsory reason for changes in accounting policy. Then, if it happen, what we have to do? For example, as I said, IFRS is getting changed, because of which India also may undergo a change. That is a change in accounting policy. Or there may be there is no proper standard applicable for a particular transaction of the company, but subsequently it has come into force. It may put the company to a situation where they need to adopt a revised policy, or originally it was not properly done, so it needs revision to give a better presentation to the reader. Then also they can change the policy. These are the various combinations wherein there may be necessity to change the policy. The standard says what are the options available and how to tackle that whenever it happens. An entity shall change an accounting policy only if the change is required by an Ind AS. So that is the first condition. So only if it is required by Ind AS or results in the financial statement providing reliable and more relevant information about the effect of the transaction, other events or conditions on the entity's financial position, financial performance or cash flows. So we have to change accounting policy only if it is required by Ind AS or it will give a better readability or reliable information to the readers. So it is from the user's perspective, not from the preparer's perspective. So you will be permitted to change the accounting policy only under these two options. Subject to the expression, a change in accounting policy shall be applied as following. A change in accounting policy resulting from the initial application of Ind AS shall be applied as per the specific transition provision in the days. So when we move to Ind AS from IGAP regime, the transition that will be covered as a last session by Chinnaswamy Ganesan sir, first time adoption. So whenever there is a transition to a Ind AS, then the respective standard gives a transition. But if you are changing in between, you're already a Ind AS preparer and you want to change your accounting policy, then you can't take a concession as specified therein. However, to cut short the difficulties for the first time preparers, a specific standard is there, both in IFRS as well as Ind AS, wherein there will be guidance how to account for that transitional differences. If the transition provision is not applicable, then you have to follow the standard change retrospectively. So that is the very first balance sheet need to be corrected. Obviously, as I said, current year we are for 31/3/21, you are giving the financials, comparatively for 20. Then there is a retrospective change means we have to give another balance sheet opening as on 1/4/19. So 3 balance sheets will come into picture. So we have to make the changes at the retrospective effect. A voluntary change in accounting policy shall be applied retrospectively. Whenever the entity itself is changing accounting policy voluntarily, then always it has to be retrospective change. However, a new standard has come into force, but it is not effective. It is applicable only from the succeeding year. But there is option to adopt earlier option. If the company intends to adopt it early, then that change will not be treated as a voluntary change. But we have to be careful. Some of the standards, their voluntary adoption, early adoption is not permitted. So in that case, we have to wait. Otherwise, most of the changes there may be there will not be any restriction. Then the company can open to adopt the change in advance. Retrospective application, as I said earlier, it involves adjustment to the opening balance sheet of each component. If I'm going to change the policy for letting fixed assets, then I have to correct the opening balance sheet. Had it been applied from the day one, what will the impact? So the cumulative effect has to be adjusted in the opening item. 31/3/21 is the current year. We are going to change. But had this policy been continued from day one of the purchase of fixed assets, what will be the effect? That will be counted, and that difference has to be corrected in the last year and also the preceding year. The cumulative difference as at the opening of the preceding year need to be adjusted in the opening balance sheet. That is one of the fundamental thing. So it is a laborious task. It's not an easy job just like that to change numbers only in the current year. We need to correct the preceding previous year and also the opening balance sheet. And it has to be done for each of the line items or each of the components. An exception is given retroactive effect to the change in accounting policy where it is impracticable to determine. They have given solution also. Suppose you don't have the details of your fixed assets and it is practically not possible to identify what is the impact had it been continued. In the case, they have given a solution because whenever we are transiting, the company would have been existing for more than 30-40 years. Hypothetically, it's a hypothetical argument, but normally, if suppose assuming that there is a carryover of assets and we don't have details, then in that case, it permits some prospective adjustment also. But that is in exceptional cases, not on a regular basis. We need to give those details on all those things. When it is impractical to determine the period-specific effects of changing an accounting policy on comparative information for one or more period presented, then we shall apply the new accounting policy on the carrying amounts of assets and liabilities at the beginning of the days period. So it is, if it is not possible retrospectively, at least from the preceding opening balance sheet, we need to do the correction. So this I already told. Whenever it is impractical to determine the cumulative effect of the beginning of the current period, then it shall apply the new policy prospectively from the start of the earliest period possible. So it is open to you whether it can be done 3 years behind or 2 years, whatever may be. That's in such situation, the entity discloses the portion of the cumulative adjustment to assets liabilities arising before the date. So we'll have a cutoff date. From this date, it is possible to comply with that. Prior to that, we will not take it over. Change in accounting policy is permitted even if it is impractical to apply the policy prospectively for any prior period. Then also it is possible. Whenever there is a new requirement, if it is retrospectively is not possible, then we are permitted to change the policy. The application of accounting policy for transaction, other events and conditions that differ in substance from those previously occurring are applied to transactions, other event conditions that did not occur previously or were immaterial or not changing accounting policy. For example, a particular transaction is happening to the company for the first time, or this is totally different from the transaction what was happening last year, then the policy adopted will not be changing. That is a new policy for the particular transaction, which is applicable only from the current financial year. So the standard clarifies that initial application of policy to revalue assets in accordance with Ind AS 16 PPE or Ind AS 38 intangible assets is a change in accounting policy to be dealt with as revaluation in accordance with Ind AS 16 or 38 rather than according with Ind AS 8. So initial application for revalue assets, whenever it is done, that will be treated as a change in accounting policy, not a change in accounting estimate. So we need to comply with the requirements of the respective standards as included in Ind AS 16 or 38 instead of going by the principle in Ind AS 8. So whenever there is a change in policy, we have to see the particular standard also. There may be some guidance whenever for the changes. So we should not simply say that this is permitted in Ind AS 8, I am following. It's not possible. We have to see whether there is any conditions or any restrictions in the respective standards, and accordingly we have to follow the principles for any changes made to the current financial year. Accounting policy disclosure. This is the most important thing. We need to give maximum disclosures regarding the accounting policy so that the users will be in a position to understand what is the policy adopted, how it is being followed, and how it will affect the financial statement presentation. So Ind AS 8, para 28 states about the disclosure. I just read out, it is more of a theory. When initial application of Ind AS has an effect on the current period or any period would have such an effect, except that is impractical to determine the amount of the adjustment or might have an effect on future periods, and it shall disclose the title of the Ind AS. When applicable, that the change in accounting policy is made in accordance with the transition provision, nature of the change in accounting policy, when applicable, a description of the transition provision, when applicable, the transition provisions that might have an effect on future periods, for the current period and each prior period presented to the extent practicable, the amount of the adjustment. For each financial statement line item affected, EPS need to be given, both basic and diluted we have to give. The amount of adjustment relating to the period before those presented to the extent practicable. If retrospective application is required by para 19A or B, is impracticable for the particular prior period or for the period before those presented, the circumstances that lead to the conclusion to be disclosed. So whenever there is a change, these are the information to be given, and some cases when applicable. So only if it is applicable, you have to give those details. Otherwise, that is not applicable. But ensure that whenever there is a change in accounting policy, all this information as required in this are given. One important thing is, since a few financial statements, they would have done a change, but they will not give the earning per share. So India 33 specifically states that we have to give basic and dilution whenever there is a change. What is the impact? So readers must be in the position. What is the increase in the earning per share or decrease in earning per merely because of this particular change? So that is more important. So whenever there is a change, in addition to the disclosure, we have to disclose what is the impact on the EPS. So this information to be given only in the year of change and need not be repeated in the subsequent year. So one time disclosure. So that is one thing to be noted. If you going for a voluntary change, what are the disclosures? There are also the standard specifies. The next para 29 states about that. The nature of the change in the accounting policy, the reasons why applying the new policy provides relevant information. That is more important. We have to justify the reason for selecting this accounting policy. As I said earlier, there may be various reasons compelling the company to adopt that. There will not be any standard properly available. Subsequently, the international forum would have developed a standard. The company thought that that would be more prudent to disclose particular or account particular transaction. Then those things to be properly disclosed, and we have to justify the correctness or the reason for framing this new policy. For the current period and each prior period presented to the extent possible, the amount of the adjustment for each financial statement line item. Wherever there is a change, we have to give what are these line item. Previously it was like this, it has change like this. And here also we have to give the EPS. The amount of adjustment related to the period before those presented to the extent practicable. And if a retrospective application is impracticable, then we have to give certain information. So this here also, this is only for the year in which the change has happened, not for to be followed in the subsequent year. So it's a one-time disclosure, both the first one as well as this voluntary change. And as I said earlier, we can adopt a new policy, though it is not, though it is notified but not made effective. Suppose today there are certain accounting standards which have been amended, which is applicable for the future year. They will amend 1 or 2 years in advance so that the user will be prepared to face the changes. If a company is prepared to take the policy unless there is any restriction, then they are permitted to do so. In which case, they have to give certain information in their financial statements. When an entity has not applied a new Ind AS that has been issued but not yet effective, that also happens. See, today the Ind AS has been amended or a new Ind AS has been issued, but the company following it only from the date it is mandatory. So it is applicable from 1/4/2023 or 1/4/2024. Even then, we need to mention those details in the financial statement so that readers will know this is a particular policy of the company will undergo a change subsequent year. The fact unknown or reasonably estimated information relevant to assessing the possible impact that application of the new Ind AS will have on the entity's financial statements in the period of initial application. So we have to say if the new policy has come, currently we are following this, now the new policy has come, new standard has come. If the company adopts the new policy, this will be impact on the particular line item or on the financial statement that need to be disclosed. So we should not just say like that, say, some of the companies will say that the impact of the same will not be material, but we need to mention the fact that what is the standard that is changed and where, from when it is effective and what will be the likely impact on the financial statements of the enterprise. So in complying with the Ind AS 30, an enterprise consider disclosing the title of the new Ind AS, nature of impending change or changes in the accounting policy, date by which application of the Ind AS is required, date as which is planned to apply the Ind AS. So it may be applicable from 1/4/24. If the company decides to adopt it from next year, they have to mention that either a discussion on the impact of the initial application of the Ind AS is expected to have on entity's financial statement, or if that impact is not known or reasonably estimate a statement of that effect. It is not practically possible to determine the impact because most of the cases is difficult. So that is the reason they are not adopting. Otherwise, they would adopt it this year itself. In this case, you have to mention that fact also. So if it is possible to quantify, they have to mention that. If it is not practical to quantify, or it is not practically possible to give a quantification, that also to be given whenever there is a new standard, but it is not effective. We will come up the questions under this changes in accounting policies. And our individual entities within the group required to adopt uniform accounting policies. Since it's Zoom, I can't give a tick option. So I've just put a question for a few seconds for your thinking. And then I'll also share the answers also. So it's easy for us to understand what we discussed until now. and individual entities within a group required to adopt uniform accounting policies in the standalone financial statement? This is the first question. Whether it's a must, if the company is having multiple components, namely subsidiaries, JVs, associates, etc., whether we need to follow a same accounting policy, whether it's a must. It is not possible because each company need to select the most appropriate policy to give a true and fairness of their financial statements. So they can select their own policy and disclose the financial information accordingly. But when we do a consolidated financial statements, then we need to have a uniformity in the policy. So the gap differences need to be adjusted only in the consolidated financial statements. So there is no bar. India does not prohibit, or IFRS does not prohibit each company, each components of the group can adopt their independent policy. For example, a company may have a holding company in India, but subsidiary throughout the world. Local requirements may require the company to have to follow the respective standards or respective policies. So the company can enforce that all the policies are as per the holding company. It's practically not possible. And the auditors' requirement, comfort, all those things will come into play. So they will prepare the financial statements as applicable to their country, and that will be shared with the holding company. But for the consultation purposes, the holding company auditors, the holding company need to collect information to identify the gap differences. Had the policy of the holding company is followed, what will be the impact? Suppose if the accounts is prepared in US GAAP or IFRS, and now it is be consolidated under in IGAAP or Ind, then what will be the gap? Those things will be adjusted only at the consolidated level, so that the group, the consolidated financials will have a common accounting policy. What are the changes in the accounting policies? So change in recognition policy, change in measurement basis, change in presentation. As I said earlier, we need to give a third balance sheet. So this case we have to give, because whenever there is a change in account balance, as I said earlier, we need to prepare, adjust in the opening, earliest to opening possible. So obviously there will be a third balance sheet we need to give. Also, India is one is also covering what are the cases where we have to, whenever there is a the entity retrospectively apply accounting policy. When we are applying accounting policy, but it is applied retrospectively, then we have to give opening balance sheet. Retrospectively restate the financial statements, any line items of the financial statement, then we have to give the opening balance sheet. Reclassified items in India, IGAAP we used to do some reclassification, but India, as I said, the consistency is more important. We can't just like that restate the financial statements or regroup the financial statements. We need to adjust and give a third balance sheet also. Whether a change in inventory cost formula is a change in accounting policy or change in accounting estimate. We discuss what is in accounting estimate. We will also look into that. Whether this is a change in cost formula for inventory valuation will be treated as a change in accounting policy or change in accounting estimate. So accounting policies are those specific principle basis I told earlier. The paragraph 36(2) of India's 2, India inventory specifically requires disclosure of cost formula used as part of disclosure of accounting policies adopted in measurement of inventories. So whenever there is a change in cost formula, it will be treated as a change in accounting policy. It's not a change in estimate, because you're changing the underlying. So it's a policy change. It's not an estimate change. Entity ABC acquired a building for its administrative purposes and presented the same as property, plant and equipment in financial year 2017-18. During the financial year 18-19, it relocated the office to a new building and leased the said building to a third property. Following the change in the usage of building, entity ABC reclassified it from PPE to investment property in financial year 18-19. Whether this is a change in accounting policy? It is not a change in accounting policy, because the asset, the usage of the asset has undergone a change, not the policy of the company to classify it as a PPE or investment property, because the underlying usage has changed from own use to letting rental income. Then it has to be treated as an investment property in accordance with India. So it is not a change in accounting policy. Assuming that the company has no policy for investment property till the last year, and because of the change they are following, it's not a treated as change in accounting. change in the functional currency of an enterprise represents change in accounting policy. It can happen. For India, we will be having INR as a functional currency. It may undergo a change because now more than 80% of the transactions are only US dollars. A functional currency itself has to be presented as US dollars, but for reporting currency can be INR, whether it will be treated as a change in accounting policy. So India is 21 details all those things. Paragraph 13 of the India is 21 specifically notes that the entity functional currency reflect the underlying transaction events and transaction. Accordingly, once determined, the functional currency is not changed unless there is a change in the underlying transactions event and condition. Thus, functional currency of an entity is not a matter of accounting policy choice. So, in view of the board, the change of functional currency of an entity does not represent change in accounting policy, therefore does not apply to change. But however, there are certain requirements under India is 21 that need to be completed whenever there is a change in the functional currency. Entity can change the accounting policy of subsequent measurement of PPE from revaluation model to cost model. So this is a relevant extract from India 16. I have shared this slide with you. So this, as I said earlier, an entity can change accounting policy only if there is a change pertinent to India or to get a better perspective to the readers. So it is permissible under India, so it shall be treated as retrospective. We are changing one of the accounting policy from cost model to revaluation model. That is, if it is done to give a better understanding readability to the reader, then it has to be account responsibility as per India 8. Can a voluntary change one or more of its accounting policy? As I said earlier, this, for example, PP again, there is an example is given. In which case we need to follow the principles given there. Example of voluntary change. See, we have an options. For example, those who are having components for associates, subsidiaries, joint ventures, we have to follow cost as well as fair value. You have to select the appropriate policy. But in the initially, the company has selected a particular method by cost. Ultimately, they thought it prudent to go for fair valuation. Then that is a change in accounting policy. We have changed the fundamentals. So from cost to fair value, it will impact both the P&L as well as the accumulated profit, and it will affect the opening profit also. We can't just like the total transaction gain. We can't just like that account in the current financial year. It will be misleading. So unnecessarily the EPS of the current year or the profit of the current year will be inflated. So that is not the real thing. Had it been continued from the day one, what will impact? So we have to adjust that difference in the opening balance sheet. Only the current year transaction difference can be taken the P&L. So it will be treated as a change in accounting policy. So this is a particular thing. We have no guidance in India, so we have followed some international pronouncement for setting out the accounting policy for the entity. And due to subsequent amendment in that pronouncement, whether we have to change the policy, whether it be treated as a change of policy. The detailed guidance have been given. As such, change is a voluntary change on accounting policy can be made only if the results in information that is labeled to more relevant to the user. How should an entity account for income tax effect on retroactive obligation or changes? See, always the tax is attached to the changes wherever it is disclosed, whether it is a P&L or other company income. The tax impact has to be adjusted and there. So if it is related to area, that has to be adjusted there. If it is related to OCA or to P&L, that has to be shown in the corresponding period. That even in IGAP we follow that. There is no capital difference in this. So adjustment of the comparative information period year shall be included in the comparative information and not as a current year charge. Though you'll be paying in the current year or you'll be paying in the subsequent year, this impact need to be shown both as well as current tax and deferred tax. Normally the mistakes will happen here. They will make the changes, but the tax effect they will ignore only the year end. The entire deferred tax impact or the current tax impact will be shown as the current year charge. That is not appropriate. The tax portion relating to that item wherever that is captured, whether in the opening balance sheet or in the preceding year, that will be accounted there. So the information disclosed in the previous year also will undergo a change. When is an entity required to present a third balance sheet? As I said earlier, whenever there is a retrospective change in the applying accounting policy, whenever there is a restatement of accounting policy and the reclassification of the financials. Under these circumstances, we need to prepare a third balance sheet in the financial statements. When we migrated to India, first year we are given third balance sheet because that is as required by the standard itself. Now, in the subsequent years, whenever there is any changes due to this, then we need to give a third balance sheet. Accounting estimates. This is more important thing. When we prepare a financial statements, we have to estimate so many things, which has a bearing on the numbers. But this time I'm estimating certain thing. Subsequent year is undergoing change. For example, current year we are classifying the useful life of the fixed as say 10 years. But in subsequent year, based on a couple of years down the line, we come to know that the estimation is not correct. 10 years is not correct. It has to be 6 years or it can be 15 years. That is a change. Whether this estimation of the useful life is treated as a change in accounting policy or change in estimate. So we need to, the standard gives a detailed guidance regarding this. The use of reasonable estimates is an essential part of financial statements preparation. A change in accounting estimate is an adjustment of the carrying amount of the asset liability or the amount of the periodic consumption of the asset that results in assessment of the present status of expected future benefits and obligation associated with assets and liabilities. Changes in accounting estimate result from new information or new development and accordingly not a correction of errors. So that is a fundamental thing we need to have in mind. So this is a new development. When we decided initially, that was I have prepared the financial to and fair view. I have not disclosed or hidden anything. But the information available in the subsequent year give me some additional information, which I feel that the estimated what I had followed till last year is not correct. That needs revision. So definitely it is not error. It's not an intentional one. So it's not error. To the extent that the change in accounting policy give rise to changes in assets. Obviously, whenever there is a change in estimate, it will have an impact both in P&L as well as in balance sheet. It can correct the balance sheet or liability, asset, or P&L profit or income, whatever it may be. The effect of those changes in accounting policy shall be recognized prospectively by including the item, then the profit and loss. The period of the change, if the change affects the period only, the period of change of unfuture period affect both. Some of the corrections may impact only the current year. That is done. It is charged off, finished. But some items may have a carryover balance which will affect the future also. Those disclosure to be given. But whenever there is a change in estimate, it has to be done prospectively. There is no necessity to reach at the previous financial year P&L or the opening balance sheet. So here the third balance sheet concept does not arise. So we need to, before going into that, we need to be clear whether it is a change in estimate or change in accounting policy. We have to go through the principles clearly and decide whether we have done correctly. Because if you are a change in accounting policy is a change in estimate and wrongly not complied with, then it will make a lot of troubles. So we need to be careful to decide whether it is an estimate change or an accounting policy change. What are the examples? India does not define accounting estimate. However, in the term change in accounting estimate is defined in India 8. A change in accounting estimate is an adjustment of the carrying amount of an asset or liability or the amount of periodic consumption of the asset that results from the assessment of the present status of unexpected future benefits and obligations associated with assets and liabilities. Change in accounting estimate results from the new information or new development and accordingly not a change in errors. So, for example, the useful life of the asset or the provision made for any of the line items. Those are all estimation based on the available information on a particular date of the balance sheet. Subsequently, that is undergoing revision because of the new information. Then it is not a error. It has to be treated as estimate. Examples. That is uncertainties inherent in business activities. Many items of an estimate cannot be measured with precision, but can only be estimated. Estimation or judgment based on the latest available information. Use of reliable estimates is an essential part of the preparation of financial statements, and that does not undermine the reliability. Obviously, whenever there is estimate, audit also will look into that. They need to have a comfort factor. If it is wrongly estimated, obviously auditor will not agree for that. They will ask the management to revise it. But if both the parties agree that estimation is properly done and it is undergoing change due to some other development in the subsequent year. What are the changes? Bad debts. Obviously, we will estimate whether the amount will be recovered in ECL method. We are in India, we are following ECL method of provisioning for trade receivables. We do a lot of estimation. What is the pattern? How it is being affected? What is the past trend? What is the future trend? And what is the status of the company? Suppose the party has failed and is become bankrupt or account insolvency, though it is less than 2 years, we make counter provision. The company will have its own policy and its estimation to make the provision. Inventory obsolescence, old inventories, it may not realize out of model. except the certain key parts, it may not be sold. So the company is not sure about the recoverability of the full amount or the cost. They need to estimate and make provision. Fair value of financial assets and liabilities. It requires a lot of judgments. So estimation is involved to the maximum. So we need to be fair in deciding the fair value of financial liabilities, useful life, as I said earlier, fixed assets or digital assets, investment property, etc. We need to estimate the useful life. Warranty obligation. This is more important. Every company now gives a warranty for its products. It can be 3 years or 5 years or lifelong. What it may be, depends on the past experience. They have to estimate what will be the likely amount that need to be spent in the future years to satisfy the customers, to comply with the warranty obligations. Those things are all coming under estimation. How it is being accounted for? As I said earlier, it is only prospective. It will impact will be given in the current P&L, and if it is have an impact in the future year also, then we need to give that disclosure. Change in depreciation method for an item of property, plant and equipment, and change in accounting policy or change in accounting estimate. It is only a change in accounting estimate. As you are aware, in IGAAP regime, whenever there is a cost that is WDV or stated, two methods are available. IGAAP, whenever we are changing from WDV to cost or cost to WDV, that we need to do the correction retrospectively and charge off in the year of change. So most of the companies will be very allergic to adopt the change because it will have a huge impact on the P&L. But in IFRS or in India's time, this is we are going by the useful life concept, but we are providing the depreciation over the useful life. So this is not a change in accounting policy. It will be treated as a change in accounting estimate, and accordingly, it will be done prospectively, not retrospectively. The concept is clear because you have decided the life was 10 years, depreciate over a period of 10 years. But after third year, you decide to change the model of depreciation. Then the remaining 6 years, you have to write off the remaining amount. So there is no change in policy, it's only change in estimate. The parent entity need to align with the depreciation method applied by its subsidiaries in the standalone financial statements with its own depreciation methods. No, it's not required. Each, as I said, in India is one itself, each company can follow its own policy, and where there is inconsistency for consolidation, they need to align. But for the depreciation, this is particularly for the particular asset, so they have to follow the policy that is best suited for that particular company. So obviously, when we are doing a consolidation, we need to give the disclosure, and the policy will not be changed in the consolidation. Now, prior period errors. This concept is only for IGAAP used to have a separate item in the P&L, prior period items, prior period expenditure or prior period income. That concept is not there. As I said, whenever there is a mistake or an omission, then need to be corrected in the opening balance sheet itself. So that effect will be given. There is no concept of prior period or extra anything in this. Prior period errors or omissions from and misspending in the entity's financial statements or one or more prior period arising from the failure to use or misuse of claim information that was available when financial statements or those periods were approved or issued would reasonably be expected to have been obtained and considered in the preparation and presentation of financial statements. So these two things to be seen cumulatively. That information was available when we prepared the financial statement for 31/3/21, and we could have reasonably obtained those information. Then, if that is not done and subsequently it is being done, means it's a prior period mistake. But if that suppose that information is not available on the day of signing of the balance sheet, and with reasonable effort that can't be obtained, management used to adopt some estimation in making some of the entries, and subsequently it is getting closed, and because of it there will be a liability. Then whether it be treated as prior period, no, this is not the case. So we have to ensure that it is intentional mistake. That the mistake could have been avoided had it been done diligently. That is the concept here. Such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights, or misinterpretation of facts and fraud. So these are the broad area. Even a mathematical mistake is a mistake that could have been avoided easily, but it has been done deliberately, or some of the ratios are being triggered, or some classification is done to give a window dressing to the balance sheet to give a rosy picture. Those things have happened. It could have been avoided while doing the preparation, and subsequently that is being corrected. Then it will be treated as a prior period error. Omission or misstatements of item of material, if they could, individually or correctly influence the economic decisions that users make on the basis of the financial judgment. Materiality depends on the size and nature of the omission or misstatement judged in the surrounding circumstances. Size of the nature of the item or the combination of both could be the determining factor. So, if because of this error, the decision taken by the reader will undergo changes that will be serious nature. So, those to be avoided. It will be classified as a prepared error. So wherever it is not practically possible, as in the case of accounting policy change, the restating the comparative amount for the period presented in the error occurred. If the error occurred before the LA's period, then we need to do the opening balance sheet also. If the mistake happened in the preceding year, we have to correct only that year. If it has happened 2-3 years back, and we need to correct and give an effect to the opening balance sheet and to give the current year impact in the current period. Potential current year period errors discovered during the period and corrected before the financial statements are approved for issue. So that is permitted. So whenever that could happen during the course of the preparation itself, the company would identify some of the errors and they can rectify. So those things will not be treated as for a period because before chain off is done, that is the current year transaction. But relating to earlier year that identified during the current year, we have to see whether it is intentional or unintentional. As I said earlier, you have to correct the opening balance sheet and also the third balance sheet wherever it is applicable. What are the disclosure? Paragraph 49 of India 8 requires the entity to disclose the following: the nature of the period error, each period presented to the extent practicable, the amount of the correction for each financial statement line item affected, and if India 33 applies to the entity for basic and dilute training pressure, the amount of the correction at the beginning of the alias period presented. If the retrospective treatment is impracticable, then we have to mention the fact. Financial statements of subsequent period need not repeat the disclosure. This one-time correction of information. Whenever there is an error has happened, we need to give this information in the notes, and subsequently we need not repeat it. But we need to be careful to avoid this because it will be embarrassment to state that I have done a mistake in the specific year that has been corrected in the current year. An entity has presented certain material liabilities as non-current in the financial statements for the period up to 31/3/18. While preparing annual financial for 18/19, management discovered that these liabilities should have been classified as current. Management intends to restate the comparative information also for 13/18. Would this classification of liabilities from non-current to current in the comparative amounts be classified as a error under Ind AS 8? Would the entity need to present third balance sheet? So in this case, so it is non-current would be a considered error, correction of error under Ind AS 8. According to the financial statement for the year ended 31/3/19 and the comparative information 13 would be corrected in the while giving the financial statement for the current year. There is no question of any third year because it's a mistake has happened only in the preceding year. It will not have an impact in the opening balance sheet. Entity charged of certain expenditure as finance cost. Subsequently, while doing that, is other expenditure. The error occurred because the manager inadvertently misinterpreted certain facts. The entity intends to restate the comparative amounts for the period presented in which the error occurred. Would the reclassification of expenses from finance cost to other expenditure in the comparative amount to be considered as a correction of error under Ind AS 8? Would this entity need to be present in the third balance sheet? Here also, the third balance sheet concept does not arise. It's a mistake. They have to definitely recast the previous P&L because it is charged for the current year. It is not carried over. So obviously, there will not be any third balance sheet question coming into force. However, if any of the amounts is a carryover impact, suppose for example, borrowing costs, capitalization, etc., it has impact on the balance sheet, then we need to see whether the third balance sheet. Otherwise, normally it is only a current year charge and it is only the grouping has been changed. That fact to be disclosed as per the standard in the AS8 and no third balance sheet is applied. So AS5 is IGAP and Ind AS 8 so the standard we are discussing now. We see what are the basic differences. Ind AS 8 also deals with the criteria of selection of accounting policies. AS5 in India we have only AS1 with disclosure of accounting policies. AS5 other than disclosure about the presentation of external items and statement of profit and loss, which is not applicable for Ind AS1. So the AS1 is very minimal, but Ind AS1 and 8 is very elaborate, giving a detailed guidance about selection of the operating policies, which is not the case in IGAP. Ind AS instead uses the term errors, but AS5 defines the term prior period items. That is concept is that we can, whenever there is a mistake that can be corrected and shown as separately in P&L, but that is not possible. In the case of Ind AS, we need to treat as errors, and if it is intentional, we need to do a retrospective correction. So whenever except some exceptions, the changes in accounting policy should be accounted for retrospectively by restatement of the comparative information. In addition, the third balance sheet, etc., to be prepared. In ASI, there is no proper guidance in this respect. We need to do the adjustments whenever there is material should be shown as a financial statement for the period in which the change has happened. So errors also, we need to give a opening balance sheet the detailed guidance in Ind AS 8, but ASI requires the correction of credit balance, including the P&L for the current period. Not much guidance. Disclosure requirement is more detailed in Ind AS 8. We need to check whether we are complied with all the requirements. As I said during my opening remark, a couple of days back, the chief has warned most of the companies are using the disclosure for a checkbox item just to comply with the minimum requirement they are giving, but without understanding the concept. We need to be extra cautious because now they are flagging with electronic filing. The regulators and the users can acquire all the information by pressing a button. So it will be difficult for us if any of the things are not complied. They can easily filter it and start questioning us. So we need to be extra careful in giving the disclosures, whether we are complied with all the standards, so that there is no deviation or omission. In ASY, there is no much difference. IFRS, as you are aware, during the opening remarks also, MPV sir said, there are certain guidance given in the IFRS, which is part of the integral part of IFRS and mandatory. There are certain guidance which are not integral part also given in the financial statements. This is explained in para 9 of the Ind AS 8, but only guidance that is integral part of IFRS has been included in Ind AS. So accordingly, the para 9 has been suitably divided. Barring that, both the standards are the same. Ind AS 1, Ind AS as well as Ind AS 8 is in line with the international accounting standard. With this, I think I have come for completion of the session. Any question and answers that we can take over. If the company has a different plans, whether the company can have a different rates of depreciation, yes, that is permitted. We are each class of us, if we plan A, plan B, we need to be specific how the depreciation has been factored. That is permissible. So this particular shareholder having 70% share is not complying with the standard requirement. We are going to have a separate session on this joint ventures and association subsidiaries. This clarification will be cleared because if I go into that is a separate area by itself. So we'll park this and we'll answer this during the particular session. Change in accounting policy. So I already explained it's only a change in estimate, not a change in accounting policy. Any depreciation change from cost model to WDV, etc. It will be changed, or useful life whenever there is a change. It is only an estimate change, not a policy change. Clarification, Mr. Ramadan, sir. Thank you. On to top to bottom. So the sales return concept that is not there, sir. Once we follow Ind AS 115, only when the risk and rewards are transferred, we will be recognizing the revenue. Till such time it will be shown as inventory. We can't recognize revenue. So the negative sales return question does not arise. Previously in the IGAP, we used to have all these things. So now even IGAP has been changed. So only if the risk and rewards has been transferred to the party, we have to recognize revenue. Otherwise, it is not possible. If that is pending, then we have to treat as an inventory with the third party and accordingly follow that. We will be getting a detailed guidance on this when we do Ind AS 115 in the subsequent days. Debit balance and cash credit account were to be present under current account or under borrowings. No, sir. It has to always available cash balance is a cash and cash equivalents. Yes, the concept is cash and cash equivalents, not a plus or minus figure. So whenever there is a positive figure, we have to show under. And similarly, when there is a negative figure in cash, current account showing negative balance, then it has to be temporary borrowings. So then it will be shown as a borrowings. It can be current. Cash flow statements standard gives more guidance on this, how to be disclosed. We need to comply with it. Sorry, I was a bit speed. I think a lot of members are highlighted. I have reduced substantially, post some sessions. Hope I was audible subsequently. Capital advance, current or non-current. Obviously, it is non-current. It's related to capital because the end use you have to see is a non-current asset. So now the Schedule 3 also has given guidance where to be, where to be shown, how to be shown. Previously, previous years when we are following AGAP, we used to show us a capital working process. We group capital advances. Now it is not possible. Capital working process only if it is a progress in place. We have to show as CWP. Otherwise, we have to show it as a capital advances. Recording, yes, I think it is available in Schedule answer. For sale, a separate standard is there, sir. It has to be treated as immediately recoverable. We have to show what is the real value. If suppose that value is not available, then that need to be disclosed with the facts. Separate line item in the balance sheet. Copy of the presentation, as I said, I will share with the institute. They will share it. Yes, sir. Whenever there is a sale of a non-current assets, it is losing its character. It is held for sale. Then we have to see it is only what is the amount to be. Can we offset lease asset balances of ROU and lease liability after the closure of the lease period? Example of building lease term. Normally, it does not happen, sir, because we will be accounting the rate of use asset under leases accounting based on what is the value. So, if there is a pre-closure only, this will come, it will be charged off. Otherwise, we will be estimating the rate of use asset with the corresponding liability in the balance sheet, and based on your present value, the interest element and the rental element will be one part will go as a depreciation, other part will go as interest element. That will be making the amount as zero at the end of the useful life. Because this is not like a normal you're building. If you're building like maybe 30 years, but your lease is only for 5 years or 10 years, then we'll be accounting everything based on 10 years as your underlying. So this question does not arise. Anyhow, we'll be getting a more guidance in the corresponding standard 116 when the speaker speaks. This is a lot of changes in the last year. So from last year, we are presenting differently. So we have to be careful and we need to have all the documentation in place so that there is no mistake in disclosing this information. OCA classification. Yes, CA, this is a new concept in India. Certain items are to be classified as P&L, certain items are classified as OCA. And for some items, there is an option available to the preparers. Fair valuation of some of the subsidiaries, etc. If you want to, then we have option whether to directly through face fair value through the P&L or fair value through OCA. When we go to the financial instrument standard, we'll be discussing in detail. But if the company has to decide the option upfront, whether they want to follow fair value through P&L or fair value through OCA, if they adopt fair value through OCA, only when the asset or liability is disposed of, that can be taken back to P&L. Till then time is not possible. In some cases, it has to be directly taken to the retained name, not through P&L at all. So there are certain things that will be explained in detail. But the concept is similarly for deferred employee benefits that assumptions, actual assumptions, this is always part of OCA. It is not part of P&L. So we need to, that is a slight change when we compare to ICAP presentation as well as India's IFRS presentation. So in international scenario, this thing will be given a separate statement. Not P&L will be separate and OCA will be separate. But in India, to have a better reading to the readers, these two be shown separately in single statement. So P&L first, then other comprehensive income, then total comprehensive income. These three things will be in a single thing. And EPS to the members, both for P&L as well as other comprehensive to be disclosed. This is a welcome change because on saying that itself, the readers can know what is the amount that is not directly debited to the P&L, which is for elsewhere. When preparing the consolidated financial statements, first time after acquiring a subsidiary, is it required to give comparative numbers for previous year? No, it is not possible because you are preparing your financial statements only from your perspective, not from the other perspective. So your previous year figure will be a previous year figure. When you are taking a subsidiary or purchasing a component, only from the date you get control, you will be consolidating. It can be during the particular in between of the year. So P&L will show only the transaction happened only from the date of acquisition. It can be from 1st January, only for 3 months, you'll be showing the P&L items. For the 9 months, it's related to the SQL owner, not for you. Similarly, balance sheet, you'll be showing only 31/3/2021 figures, not that is taken over. We'll be doing some adjustment in cash flows to show these movements because assets will be added and the cash flow will be changing. We will be paying purchase consideration. When we do the consolidation, only for the period from which you got the control will be disclosed, will not be, but we have to give a detailed note saying from this date the so and so component has been acquired, and these are the adjustments made in the financial statement so that the readers will get a better perspective. Standard business combination will give more guidance on that. Mandatory to give classification of income for each activity separately, or can give revenue from operations. That to be broadly classified for sale of manufactured goods, sale of trading goods, etc. But if you have a material line item, it is nothing wrong giving additional line disclosures. So always to give a better readability to the readers. If you have to follow the requirements of Schedule 3 also for this purpose. Seasonal business, I think I have covered. I'll go to the last of the material. Separation policy I covered. JB I told. Sir, reversal of sundry creditors not recoverable into income is the change in account. No, sir. There is because of time barred or some dispute or some reason it is being credited to P&L. That is accepted unless there is any reason that will be shown as a current year transaction, not as a change in accounting policy. There is no policy element involved. You accounted the purchases correctly, you have accounted the liability correctly, but due to subsequent development which has happened in the current year, you are writing back the amount, writing of the amount. Just like trade receivables, you are making provision, subsequently you are writing it off. It is not a change in accounting policy. Same concept applies to here also. Similarly, you return offset an amount in the earlier year, subsequently it has been realized in the current year due to a party. The case would have gone to NCLT, you would have made the full provision in your book subsequently. Considering the status, you would have thought fit to write off the full amount. It is written off fully and not removed from the books of account. But at the time of final settlement or liquidation, some amount you are getting, that will be shown as a credit in the P&L. That is not a change in accounting policy. Change in accounting methodology, change, yes, correct. It is change in accounting estimate. Seasonal business agriculture related, I had told already. So this I'll just flag when we go for this Ind AS 115, we'll cover this. Okay. Thank you for the confidence. DTA detail offsetting is allowed presenting net value only if it is in the same tax regime. If you are having subsidiaries in India, then you can do that. But if you are having a subsidiary outside India, if it is a different taxing, you are not permitted. You could have seen from a larger balance sheet, there will be disclosure of both DTA and DTL. So we have to ensure that if for Indian, if a company having only components only in India, then definitely that is permitted. Otherwise, not permitted. There is separate guidance for that also. No, OC is something different. It is nothing to do. In IGAP, we will not have this concept of fair valuation. That will be only in your outside the books. So in books, we will not bring anything. But in international financial analysis, we are going with the fair valuation concept. So wherever it is not a realized profit, that will be done through P&L, you have option. So if we are taking option through P&L, there will be volatility. So they are giving option to the preparers to take it either to OCA or to P&L. That information will be disclosed. All the information available in P&L in the financial statements, so the readers can understand what is the amount, where it is credited and all. So there is no misleading. Definitely, it will to give a better understanding to the reader. And similarly, India is more conservative. For example, investment property in IFRS, we can follow both revaluation model or cost model. But India only cost model is permitted for the preparation of financial statement. But we can give the impact of revaluation in the footnote. Not that the profit we can't take it to P&L because that is not operating. But for PPE, we have an option to go for cost model, revaluation model, and accordingly we can. So when that balance sheet is required, as I said earlier, whenever there is a retrospective, we are uploading any accounting policy. Accounting policy we are planning to adopt from old date, or we are restating financial statement retrospectively, or reclassifying any items in the P&L, or any errors in the P&L. These cases we have to adjust in the earliest balance sheet, and accordingly, when we are giving a financial statement for 21, 20 is the corresponding figure, but we will be adjusting from 1990 or 1995, etc. Those effects till 31/3/2019 need to be affected and given as the opening balance sheet as of 419. This is the third balance sheet that is peculiar for Ind AS and IFRS. I hope I clarified your query. Thank you, Mr. Raman. Though I was a bit fast, I'll try to reduce that. That is my normal speaking speed. I reduced a lot after getting a first point. Thank you. Thank you. Yes, it's a good refresher, both for me also. See, India is more of a theory. We are doing it day in, day out. Certain things will be in the back of my mind without even understanding where it is stated. We will follow that. There is nothing wrong. But whenever there is a doubt, please read the standard once again. You will get a different perspective. So always it is better to read the standard again and again to get a new understanding or new ideas so that we can enforce these standards.
Thank you, sir.
Thank you. All of that's a compliment.
Yes, sir. Compliment. And that's a vote use a vote of thanks.
Yes, yes. Sir, thank you very much, sir. Ramaswami sir, great job, and your coverage was so wide. And I think most of all the queries from the attendees also answered, and it is very useful to every member, it seems. And we especially thank you for this program being at very early in the morning, from 7:30 itself. Your passion and your commitment to the profession and your love towards the alma mater CA Institute is depicted in your presentation at this hour. You're always, people like you are the real pillars of our institute. Thank you very much for your time, sir. And
thank you. Thanks for your opportunity. I thank you all the participants for their time and effort joining early in the morning. It was thank you. A lot of questions. If I have missed any of the questions, my email ID will be in that presentation what we shared with the institute. You're open to ask me. I'm always available for any further clarification. Thank you. Have a great day. Have a great weekend.
Thank you. Thank you. All the participants, thank you very much for your interest in this. And also, we assure you that the PPT will be shared with you shortly. Thank you very much.
Thank
you. Good day, sir. Good day, sir.